Hello, everyone, and welcome to our webinar. My name is Saar Menachemi, and I head up Intap's field marketing and client development efforts. Today, we will share the results of the Spring 2021 Dealmaker Pulse Survey, along with data-driven takeaways specifically for private equity firms and fund managers, investment bankers and advisory firms of all types, as well as credit firms and leveraged finance professionals. Before we begin, we wanted to take a moment to review a few housekeeping items. We, the DealCloud team, and myself included, are currently working from home. In my case, in beautiful Queens, New York. So there may be an occasional background noise like a siren that we hope you excuse. Even 15 months into a remote working environment, Zoom may still experience high usage volumes, and we may temporarily have connectivity issues or slowness. While unlikely, it's worth mentioning that if we or you have any issues, this session is being recorded and will be sent to all after the webinar is finished. With that said, let's get started. For those of you I haven't had a chance to meet, my name is Saar Menachemi, and I joined DealCloud almost 4 years ago with a long history of working with private equity firms, investment banks, lenders of all types, and M&A professionals throughout my career. Before joining DealCloud, I spent many years at iLevel and subsequently Ipreo's private capital markets group. And before that, I spent many years at Intralinks as well, working with both the buy and sell side, private equity funds, and loan syndication desks. The spring 2021 edition of our report is the first to trend information over a 12-month period. And I'm excited to share the results of what we gathered. But first, I thought it would be helpful to give a little background on how we conducted the survey and ultimately how we were able to crunch the numbers that we did. 1 year ago, we issued our inaugural DealCloud Dealmaker Pulse Survey so that we could learn more about the trends and issues affecting professionals in the capital markets industry, especially since, as I'm sure everyone knows, March and April of 2020 was really uncharted territory. We asked about a dozen questions of professionals at private equity firms and fund managers and bring you the results of our third survey. We have found that it is flush with new data showing how the broader market has been affected by trends and how sentiment has shifted over time. The survey was conducted just a short time ago in late April and early May, and all of the responses are anonymous. For those not familiar with our technology, DealCloud offers a deal, relationship, and firm management platform, and like our 900 plus clients, we use our own technology to run our operations. We like to think that we drink our own champagne. Part of that is using our marketing technology solution, Dispatch. If you've ever received an email from DealCloud, or were invited to this webinar, or have received our newsletter, then you've received an email campaign from Dispatch. Specifically for this survey, we used Dispatch to create the survey's webpage, to distribute the emails asking private equity professionals to participate, and to collect the anonymous results. If you have any questions about Dispatch or the DealCloud platform, be sure to visit www.dealcloud.com. You can click on Request a Demo, and a member of our team would be happy to show you how our technology can help power your process. Looking at the responses, we thought we would start with the people that responded to our survey. As mentioned previously, we surveyed fund managers, the vast majority of which were either private equity buyout funds or had growth equity strategies. And we're very thankful to all of those that responded and provided their insights for this survey. Responses came in from both DealCloud clients and funds that are not using DealCloud as well. As you can see on this slide, the largest set of responses came from investment professionals or deal team members. But we also have representation from investor relations, marketing, IT, operations, and finance. So we feel that there's a good cross-section of most firms. A large number of respondents identified themselves as either members of their firm's executive committee or who were partners or MDs. In fact, 62% of the responses came from senior people at their firm if you look at everyone who identified above the VP level. We also saw an even spread of firms of all sizes, ranging from boutiques, many with less than 10 professionals, to larger firms with over 100 professionals, and truly firms of all shapes and sizes in between. We feel that all firms are represented fairly well in these results. So with that said, let's dive into the findings. The first question that we wanted to highlight is gauging the sentiment around competition for assets. And again, this is our first report that trends information over 12 months. And we're able to see how that sentiment has shifted over time. If we go back in time to the spring of 2020, right at the onset of the pandemic, there was some sentiment that there might be more competition, with 22% feeling that way. But the sense at the time across almost half of the respondents, 42%, was that there would be less competition than before. Now, at the onset of the pandemic, I think that was a fair guess for everyone involved. But as you can see, that sentiment changed drastically over 12 months. The majority of respondents, or 67%, feel that today there is more competition than in the previous 12 months. Now, there are lots of market dynamics that went into that, including fundraising, dry powder, strategic acquirers, and other items that affect these answers, and we'll dive into those in just a moment. Now, interestingly enough, not everyone feels that way, and almost 35% or so feel that it is either the same level of competitiveness or less. Now, those are certainly in the minority, but it'll be interesting to see how this sentiment changes over time in our forthcoming surveys. The next question that we wanted to highlight asks whether or not their firm has closed any deals in the last 6 months. And the number that jumps out at me is on the left, which are firms that have closed both new platforms and add-ons. In fact, it is almost 75%. That number is up drastically from the previous report. It is up 37% at the expense of every other category that you see on the screen. What that tells me is that the original thought going into the pandemic that it would be difficult to close a transaction or that some firms might sit on the sideline has certainly not come to fruition. And we're seeing lots of activity, and the responses from this survey echo that. Now, it's important to notice that 12% of firms have closed no deals in the last 6 months. That is down a significant percentage from the previous survey, but it is still worthy to point out that there are firms that have either waited for the appropriate opportunities or are still gauging their pulse on the market. We thought it was interesting as well to see the mix of firms that have either closed only add-ons or only new platforms. So we have included these numbers here as well. The only question that we ask that allows multiple answers or choose all that apply relates to the respondent's perception of their firm's biggest challenge to execute on their strategy over the next 6 months. And again, we now have information that spans the last 12 months, and there's some interesting takeaways in these numbers. The first one is, generally speaking, most of the respondents felt that prices and increased competition are now the biggest challenge for their firm to overcome. Just 6 months ago, only 28% of respondents felt that way. And this is the largest change in any of the numbers on this slide, to go from 28% in autumn of 2020 to 62% in this spring. Now, a lot of this is driven by firms looking to make investments while being remote, but we also think that this is driven by increased fundraising dollars and the need to deploy capital across multiple strategies. And we'll get into some of the fundraising statistics and sentiments in just a few slides. The other item we wanted to highlight is the perception around lack of attractive assets to buy. Now, this is an interesting one over the last few surveys, as about a quarter of people just a year ago felt that there were lack of attractive assets to buy. And while that sentiment shifted downward in the autumn 2020 survey, it has really taken a step back in spring 2021. Now, a lot of this might have to do with where people are finding opportunities to invest and deploy capital. And we'll take a look at that sentiment in just a moment. But just a year ago, this seemed to have been top of mind for many people. And it will, again, be interesting to see how this metric changes in the next 6 months and in the next 12 months as well. A few more items to highlight is, not that long ago, there was a sense that it would be difficult to court either co-investors or to raise capital to do the deals that needed to be done. And that sentiment seems to have changed over time drastically as well. Not that long ago, it was the second most popular answer, just 12 months ago. And now it's really fallen below 10%. The last thing we want to highlight is there seems to be a steady and potentially increasing concern over any changes to the regulatory environment and any changes to the tax outlook, especially in the United States. So while this has sort of held steady at 8% over the last two surveys, this is one that we're going to keep an eye on, especially as potentially new laws are enacted, both in the United States, but also across the world. The next question asked, where is the firm going to put its focus and attention over the next 6 months? And again, we have 3 different survey periods to highlight. And this was a question that they can only answer once. The obvious number that jumps out is 84% of respondents said their primary focus over the next 6 months is in acquiring new companies. Now, this was also the most popular answer in the autumn of 2020, but it really took a significant jump, especially year over year. I also want to highlight that this kind of goes in hand with a drastic change around firms' sentiment around either mitigating the effects of the pandemic or working with their portfolio companies to shore up operations. 12 months ago, which might have felt like another lifetime ago at this point, 45% of firms felt that this was one of the most important things they need to focus on. And today we're seeing less than 10% respond this way. I'm hopeful that this represents that most companies have shored up their efforts in the pandemic and the work from home environment, and that most firms are returning back to normal, including private equity firms, and fund managers who are now reshifting their focus back to acquiring new companies. The next question we wanted to highlight is, where do people feel that transactions are going to come from over the next 6 months? And again, they could only respond once to this question. Now, there's some interesting data here that we can look at over the 3 periods to see how sentiment has changed. But I wanted to highlight a few things quickly. The first one is the number one response was founder sales. Now, this is up slightly from autumn, where half of respondents answered that, but it's a big jump up from a year ago when only 22% of respondents answered that way. The next largest answer is sponsor sales. And if you take these two together, it represents the vast majority of respondents, approaching 80%. Now, interestingly enough, not that long ago, many firms felt that corporate carve-outs and recaps were going to be the most popular transaction types. And in this case, that sentiment has changed drastically, and both represent under 10% of total responses. It'll be very interesting for us to track this over time. And when our next survey results are published, we'll be able to look back at these answers and see how that sentiment has changed. Now, what that means for our intermediaries, advisors, and investment bankers on the phone is that these are the transactions that most of the sponsors that responded are expecting to see: founder sales and sponsor sales. For any lender or leverage provider on the phone, this is the type of transaction that people are expecting to see. So if you have experience in these types of transactions, it would probably be a good thing to lead with that. I touched a little bit upon fundraising early on and sort of the downstream impacts that it has on most of the survey answers. And this data comes from our friends and partners at Preqin. And what this shows is private capital that's been raised over the course of 15 years. Now, there was a little drop off in 2020, which is likely to be expected, as there were a few months where either travel wasn't feasible, or many LPs were probably trying to shore up their books or reassure their retirees around sort of their portfolio mix. And the public markets were certainly in flux for a few weeks. But if you take a look at 2021, we're about halfway through the year, and it looks like we're on pace to match the previous output of fundraising over the last 2 or 3 years. Now, if you think about all of the capital raising that's been done and the need to deploy capital, that is sort of what, in our view, is helping to drive the competition and the perception around the irrational prices. So what we wanted to do was take this fundraising sentiment and ask firms where they will be focusing their fundraising efforts. Now, this was a relatively new question in that we only asked it twice, both in the autumn 2020 survey and in the spring 2021 survey. But what jumped out at us was that 45% of respondents, up significantly from last time, are not only proceeding with their next fund, but they feel it will be larger than anticipated. We think that this is only going to help compound the perception around increased competition and the irrational price answer. This question, if you will, has the potential to be a leading indicator to some of the other questions that we previously asked. Now, what you'll also see here is that some firms are proceeding with either the same size fund, 6%, which is the same answer as last time, are proceeding with a fund that was smaller, and a very small handful of respondents are postponing their fundraising. Now, that answer dropped off significantly in just 6 months, but the vast majority, or 75%, are proceeding with the same fund size as anticipated or larger. Part of fundraising and the feedback that we have heard from our clients is that there is an increasing reliance on ESG metrics, or environmental, social, and corporate governance metrics, that are part of not only their day-to-day operations, but also their fundraising efforts. So we asked whether or not their firm is seeing an increase in both the requests for and the importance of tracking these metrics. And as close as possible to consensus, 99% of responses said that they are seeing either the importance of these metrics staying the same or increasing. Now, as more LPs incorporate ESG metrics into their due diligence packages, we think that this will only increase in importance. So we wanted to start gauging this sentiment, and this was the first survey period that we included this question in, but we will trend this information over time and see how this changes. It's difficult to read any news source lately without seeing SPACs and the effect of SPACs on the IPO market. This chart comes from our friends and partners at PitchBook. And what it's showing is the number of SPACs that have filed or have gone public, as well as the amount of capital raised using SPAC vehicles. And you can see it was a significant uptick in activity starting in 2020, even though SPACs as a vehicle have been around for some time, although rather unpopularly before 2018. So the question we wanted to understand is this a special time for SPACs, but specifically in the sense of private equity fund managers, and whether or not they view this as a vehicle of interest. Now, 74% of responses said that their firm have no plans to launch a SPAC, and that's certainly a respectable answer. Now, what was interesting from my perspective is that almost 25% or so of firms responded that they have either already launched a SPAC or that they are evaluating the advantages of doing so. Again, this was a new question that we asked for this survey. And as the market for SPACs continues to either increase or be really looked at in the market as a way to either provide liquidity or an exit for an investment, this is another question that we look forward to trending over time, and to be able to look back at this baseline answer that around 75% of responses had no plans to launch a SPAC at this time. Another headline that's driving the news is in relation to talent. Now, many of these headlines aren't necessarily specifically about private equity firms or fund managers, but many of these headlines actually impact the amount of people that try to potentially work at a private equity firm. And it's interesting to see that this concept of talent, whether it's entry level or junior employees or hiring or retention of employees, has really been bubbling up quite a bit throughout the various news sources. So we asked another new question on this survey as it relates to talent acquisition and retention. Now, this was a question that people could only provide one answer to. So we are seeing some interesting results that almost 60% of respondents felt that their firm had some form of hiring or recruiting or talent challenge. Now, the largest answer here, which is 33%, was developing junior staff. which obviously is an important concept in most industries, but that seems to be one of the main things that's on people's minds at the fund managers that responded to our survey. Another interesting one is hiring and recruiting outside talent. Now, the pandemic might have changed the way people either hire or recruit. Historically, people would come into the office, they would be able to meet and interview candidates. And we know that over the last 12 months, in some areas, that might have been more difficult. And many firms have either hired or met people virtually that they have never met in person. I myself have found that as well. Today, only about 30% of firms feel that they don't have a talent challenge. That is the minority of firms that responded here. And again, this is the first survey period that we have asked this question, and we think that this will be another interesting one to trend over time. We wanted to wrap up with some key takeaways. The first one, and this was the number that jumped out the most in the entire survey, is that respondents are hyper-focused on closing new acquisitions. Due to that fact, there are day-to-day implications for any firm that is listening to this webinar. Sponsors are looking to sell assets. Intermediaries and advisors need to act as the brokers and the transaction runners on those deals. Debt providers need to provide leverage and additional liquidity options to all of these players. And given the fact that many respondents felt that either founder sales or sponsor sales are going to be the major source of deals, these two bullet points, I think, really set the tone over the next 6 months. One of the items that seems to come up more often in our clients is the concept of covering other sponsors the way that they would cover intermediaries or investment banks, lenders, and other deal channels like lawyers and advisors. So this concept of sponsor sales becomes increasingly important to track not just other sponsors, but their potential portfolio companies that might be coming to market, and leveraging our data partners to augment your proprietary data around that. Maybe no surprise to anyone in the investment community, the vast majority of deal makers were concerned with irrational prices and increased competition. And again, there are multiple factors that go into this, including strategic acquirers having lots of cash that they can deploy. But we feel that fundraising and the fundraising trends that we've seen will continue to drive increased competition in the market, which only speaks to the importance of having a market coverage and market pulsing technology. We also thought it was important to highlight the importance of ESG metrics, especially as people raise larger funds, as almost half of respondents are planning to do. DealCloud offers a deal, relationship, and firm management solution that is leveraged by 900 plus private capital and investment banking firms globally. We currently support private equity firms, fund managers, and investors of all strategies, investment banks, M&A advisory firms, lenders and credit funds, and strategic acquirers of all sizes and all types to ensure the ideal outcome for their firms and their clients. We help them keep track of mission-critical processes, including their deal relationship, management, and report on all dimensions that are critical for them to manage their firms. For additional information on how our technology can help your firm, please visit DealCloud.com. One of the things that we wanted to finish with is to highlight our data partners, many of which you've seen data from in this presentation. We offer our data Cortex, which allows us to take data from our partners, PitchBook, Preqin, SourceScrub, SPS, Privco, FactSet, and SAP CapIQ, and augment your proprietary data that is tracked in your version of DealCloud. We'd be happy to show you how this works, especially if you're already leveraging one of these data sources, to take the information that you have about people, companies, firmographic data, and market transactions and lay it over the information that you have. Thank you so much for joining us today. We encourage everyone to visit dealcloud.com/pulse to download the full report. As a reminder, this webinar was recorded and will be made available on dealcloud.com shortly. Lastly, please be sure to visit dealcloud.com/webinars for more information on our other upcoming events. Thank you again, and have a great day.